The US dollar staged a massive rebound on Friday on the back of the non-farm payrolls report. This week is an even bigger one with inflation data and the FOMC rate decision. What does this all mean for the dollar, guys? Ken Chigbo back with another E8 market update. Let's jump straight into this. So starting off with the US dollar, explosive moves were seen on Friday on the back of the monthly jobs report where 272,000 jobs were added to the economy. The average hourly earnings jumped up to 0.4%. And also the unemployment rate was a slight negative. That jumped up to 4% from 3.9%, but remains generally steady. Now, when you look at the jobs report at plain sight, at surface level, it does look very hot indeed. However, there's some components that get overlooked, but when you dive deep into the data, such as household employment, okay? What is household employment? Well, with household employment, unlike the payrolls, household employment covers a broader spectrum of jobs, right? Where we've got self-employed workers, where we have farm workers. We also have private household workers as well. And when you look at the figures, the full-time workers there in a household survey declined by 625,000, while those holding part-time positions increased 286,000 jobs. Now, that actually does suggest that there are economic cracks there, okay? It's a big drop when you look at the amount of full-time workers. So at some point, potentially this could take its toll. Now, so if you look at my screen here, guys, the big thing for me when I see those dollar balls coming back into play comes with the average hourly earnings. That's the most important thing. That's very inflationary. The fact that we've got higher wages, you know what that means on a macro level, right? If people are getting paid more money, they're going to be more inclined to want to go out and spend this more money that they're getting paid. Spend, stimulate the economy, buy these goods, use this service. And of course, businesses are loving it. And then they're going to keep their prices high, okay? Prices will remain high, inflation will remain sticky. So that's inflationary. And I think the FOMC are going to really be locked in on the fact that earnings are going up. That's not what they want to see. They want to see earnings coming down. They want to see the unemployment rate going up. They want to see the amount of jobs being added to the economy going down. So look, what I want to do at plain sight here, when we look at the dollar structurally, we were obviously trending to the downside. Now, I'm going to clear this up a little bit. And the reason being, and this is where it's important to have your finger on the pulse with fundamentals. Of the NFP, that jobs report has thrown a spanner in the works there for that potential downside where we're trending. Now, there is the possibility with this dollar, the dollar index here, when you look at that, okay, obviously everything comes at a different perspective, but we could have a potential bullish channel here, descending channel subject to a breakout. Now that breakout could come where we do focus on a couple of key data points this week ahead of obviously the FOMC, where we get the core CPI and the CPI readings, okay? Now inflation in general expected to remain steady. Okay, it's expected to remain steady. Ahead of this data, we have seen signs of disinflation, but there's also signs, as you see there, with the wages going up, signs that inflation could be not falling as fast as the FOMC would want to see. And especially, as I say, with those wages, I believe we could get a pushback from the FOMC this week, which obviously if they push back on the way markets are pricing in rate cuts right now, okay, and then if we look at the CME Fed's watch tool, which tracks the probabilities of those rate cuts, look now in September, okay, this has dropped down to 50%. We were above 60% ahead of the non-farm payrolls number. And now the probability is a 50% easing in September. If we take a look at November, 64%. These are all like 90, 80%, and December's dropped down to 86.3% probability to ease. These are all like above 90% when you look at the latter part of the year in November and December, but the odds have now dropped given that latest jobs report, as I say, which has thrown a bit of a spanner in the works. And now we could potentially be set up for a dollar upside. If we do get a dollar upside, we need to break this heavy area of supply now, which was former demand. We need to break this heavy area of supply around that psychological 105 area, and we could have a nice push to the upside and go and challenge those highs there. If you look at euro dollar, because obviously euro makes up over 50% weighting of that Dixie. If you look here, right, we still, albeit price action is very choppy and directionless because we're waiting for those clear signs of a breakout with regards to divergence with one central bank and the other. And when we look here, despite obviously the ECB did cut rates, but they pushed back on further rate cuts, we look at this as potentially still following some sort of structure where we've got lower high, lower low, lower high, lower low. And maybe this is the new lower high, and potentially we could go and print a new lower low at 105, especially if we get a hawkish FOMC this week. So do keep an eye on that inflation data and, of course, the FOMC on Wednesday. The Japanese yen, expect some volatility there because we do have on Friday the BOJ rate decision. Now, they're not expected to change interest rates. There is expectations for them to start trimming their bond buying. You know, if they're bond buying, this is a form of QE where they're effectively pumping money into the markets, providing liquidity there to try and bring up inflationary levels. Remember, when we are pumping money into the economy, it's inflationary. We're trying to bring up those inflationary levels, and that's exactly what the BOJ have been doing. Now, obviously, over the past month, you've seen weakness in the Japanese yen, despite the fact that the BOJ finally moved away from negative rates, okay, and they moved to zero. But we can't deny the underlying macros, the fundamentals there, where people in Japan will continue to borrow where interest is cost them nothing, okay, interest is low, zero. And then what they go and do is go and invest in high yielding economies. So what happens is we get demand for yen falling, okay, they sell their yen and they go and convert it into other currencies such as the dollar, GBP, CAD, Aussie, NZD, Euro, the list goes on. Okay, so that can't be denied until the BOJ starts to raise interest rates further. But I don't expect them to be doing that anytime soon because the Japanese economy still remains vulnerable. It's on the brink of recession. Now, if you look here, first of all, you would have seen obviously a slowdown, as I said, recently with a lot of the yen pairs, but we just technically ran into these heavy areas of supply as well, as you can see there with UJ. Look there as well with EJ. There's just heavy area of supply. Now, if we take UJ as an example here, we could end up staging a rebound, particularly if the BOJ doesn't indicate at a rate hike again coming soon. Markets are hoping that they do it again in July, but it is kind of unlikely just given the vulnerabilities of the Japanese yen. So these flows into the yen that we've seen of late, they could be very much capped and short-lived until the safe haven narrative and scenario picks up, which I will expect it to pick up soon. But as I say, if we do get that pushback from the BOJ in terms of incoming rate hikes and they don't do it anytime soon, then expect that yen to continue to weaken and we could see those pairs push further to the upside. The Australian dollar. Now, we do have important labor market data from Australia in the form of employment change and the unemployment rate. Now, one of the key things with the Australian dollar right now is markets are trying to suss out what's next from the RBA. Now, they have made it clear that their next move could be either a rate hike or a rate cut. Now, the reason being for the rate hike is because inflation remains sticky in Australia. They're not going to rush to start cutting rates with inflation remains sticky. Because remember, if we cut in rates, we start lowering people's costs and then people will start going out spending more money and stimulating the economy, and then prices of goods and services will remain high. For the rate cut, there are some vulnerabilities. There is a clear economic slowdown in Australia with growth slowing down. Just general signs of economic cracks in Australia. So we're going to really focus on this. If you look last week, firstly, just on my point on cracks in the economy, GDP coming down to 0.1%. So lower growth on a quarter-on-quarter basis there for Australia. When you look at the employment change, expected 30,000 jobs being added to the economy, which is still relatively healthy. And the unemployment rate expected to tick lower to 4%. Now, obviously, with the RBA, they're not going to want to see this. If we get bullish figures here, expect Australian dollar support, because it just means the RBA are going to push back on any rate cuts. And if anything, they could hike rates, because if this is bullish, that's inflationary. Remember, if we've got a decent labor market data, it means more people in the workforce out stimulating prices. That makes sense, okay? Now, with Australian dollar, if we look here, obviously there's other Aussie pairs you can look at, other Aussie crosses, but I'm just making it clear here that we remain in a tight range for the Australian dollar here. Okay, because it goes back to what I continue to say for weeks and weeks. Don't beat yourself up about it. We're not getting clear trends at the moment. You have to trade in these ranges. We're not getting clear trend breakouts yet until things are very, very clear on a central bank level, and we start to get those divergences forming where one central bank is cutting faster than the other to give the other currency the edge, and also economic performance as well. And everything is just back on a level playing field right now. So we really need to get these range breakouts. But I mean, when you look here, there is obviously risk. We're nearing a breakout at the end of the day. Look, if we were to put a trend line there, put a trend line here, you can just see that triangular structure, and it could go either way. We could break out to the upside or to the downside, guys. You just have to trade within these ranges right now. But expect that Australian dollar volatility. As I say, look at certain Australian dollar pairs outside of the dollar, because we've got a lot of volatility there as well, with obviously with the FOMC and its inflation data. But you can look at other Aussie currencies. If that data does come out bullish, expect the Australian dollar to gather some strength. So plenty of volatility there, particularly surrounding the dollar-related, Japanese yen and Aussie dollar. Other than that, that's it from me. Have a blessed week, and I'll see you on the next video.